Hello, I'm Ron Williford. We're here today for Let's Talk Money. Today we're going to be talking about some general topics in financial planning. My guest today is Terry Robertson. Terry's a financial coach. He's going to give us some of the hottest topics that are in the marketplace right now. Terry.
Yes.
So how long you been in the business?
Well, first of all, thanks for having me. I really appreciate it. Been in the business independent for about 5 years. Met a lot of cool people over the time, and we're really just focusing on building wealth and some of the topics like you were mentioning, wealth development, right? Wealth creation, I like to call it. And protecting the wealth once you've created it, right? And just some general questions that people may have about what to do with some money once they have money and how to move money. And then once they're getting close to retirement age, if they should just keep doing it the way they're doing it or if they should do something different.
Okay, so now you mentioned getting started with financial planning. What's the first step that we look at when you start financial planning?
Well, first of all, that's a great question. And I think that, first of all, the problem is that some people think that they don't have enough money to get started.
True.
That's the worst thing to think,
I still
right?
think I don't have enough.
Yeah. All right, we got to get started somewhere. What I love to tell people is that, education and information is free. So I really believe in sitting with almost anybody that wants to get started because I believe you got to start somewhere, right? And then once you start, and also statistically, they tell people, I've read a statistic that said that you are 3 times more likely to retire on time if you work with a financial coach or somebody that knows what they're doing.
That's probably the best advice you can give.
Right, yeah. So they got to work with somebody. A lot of times people are doing it on their own. They don't know how to do it. And I tell people all the time that if you're not a mechanic and something goes wrong with your car, you send it to a mechanic. But we don't have financial education. We didn't really grow up learning it in school, personal finance. So it doesn't make sense that we actually know what to do with our money. So we need to sit with somebody, consult with somebody to get started. So the first thing is to get started. Sit with somebody that you trust, that you believe in. Listen to their information and actually utilize the information once they give it to you instead of just saying, thanks.
Okay. Now we're in the midst of tax season.
Yes.
A lot of folks are looking at their tax returns and looking at ways that they can save money going forward.
Yeah.
What do you think relative to today's tax world?
Yeah.
What do you think are some of the pressing issues that we should put at the forefront of our agendas?
Yeah, and so once again, these are just my opinions. The first thing is that I feel if you do get a sizable tax return, I think you need to pay yourself first. Right, that's the first point. I think that people traditionally, they're literally thinking about what to buy.
Big screen TV,
right? Before they even actually get the money. Right. So the first thing is to pay yourself first. Treat yourself like the CFO of your business, of your company. You are the CEO of your companies. Treat yourself that way. Pay yourself first, and then from that point, look at other ways to develop your money. It gotta grow. So let's look at other vehicles. Maybe are you on track for retirement, right? If you're not on track, well, you gotta start doing things to get yourself on track. Statistically, a lot of people don't even think about retirement until they turn 40. And that's scary because that means you still want to retire at 60, 65 or whatever the case may be. Time is no longer on your side, so we want to make sure that you do the right things. I will say this, though. Some people have said to me recently, I want a big tax return. I actually disagree with that. I think you shouldn't really want a big tax return.
I agree. That's a part of my philosophy as well.
You shouldn't really want it because if you're giving Uncle Sam, a tax-free alone, basically, for the whole year. They've done what they wanted to do with your money, and then they give it back to you. Right. And I try to teach people, do you want more money at the end of the year, or do you want more money throughout the year? You can increase. So speak with a tax professional. Make sure that, your deductions and your contribution, all that stuff is working in your best interest so you can have more money month to month so you can invest more money and save more money for your future.
Right. Now, you had mentioned the tax refund.
Yeah.
A lot of folks are getting these big refunds.
Yeah.
What's the best way to adjust that, and how can they utilize their paycheck to maximize what they're earning each year?
Yeah, that's a great question. So it's twofold, right? The first thing is that you always want to make sure that if you're getting a sizable amount, that you adjust your deductions.
Okay.
That's an important way. That's an easy, simple way to do it. But talk to a tax professional while you're doing it, because you also don't want to then all of a sudden flip it too much and then now you're owing money, right? So look at it, as an example, I met with a client and she was, got a tax return back of about $5,000, and I was like, that's hefty. Yeah, that's too much. Let's reallocate and readjust, because people say to me all the time, my goal is to find money for you. And that's how that's a trick and a way that we find money. Let's look at your tax deductions. And so we look at that, we adjusted it. The next year she got back $2,000. So $3,000, the difference funneled through her monthly checks, or biweekly checks. And so that really helped this client, because now they were able to invest in investment products that previously they weren't able to afford.
Now, does the government give you any incentives to save for retirement?
Yes, that's a good question. So some of the tax, so a good one is the Roth IRA.
Okay.
I love the Roth IRA personally, because I believe that, the way it works, and I know it comes, the money, first of all, has already been taxed, right? But the cool part about it is that you put the money in, it's the focal point is retirement, right? And this year it's changed in amounts. It's gone to $500 a month, or I believe it's $6,000 for the year.
Okay.
With a $1,000 catch up after age 50. But the cool part about this, and this is what I love, once that money goes in, most of the time, Uncle Sam still wants his money normally, and most other investments, on the capital gains or the money that was accrued in it. Right, you got to pay that money. But in a Roth IRA, it comes out tax free. And so that's a benefit, all that money that you gained over the years. That's the benefit from Uncle Sam. They're saying you don't ever have to pay taxes on those gains.
Now, what about if, God forbid, something happened to you and you died? What happens to those Roth
That's dollars? A good question as well. There's a beneficiary option on those, so that money can go to a spouse or whatever the case may be. So the cool part is it's not just going to Uncle Sam, or it's just not going anywhere. You do have a beneficiary option on those accounts.
Yeah, so one of the things, I think the biggest ticket today is taxes.
Yeah.
So I think even if you saved, you've got beneficiaries. And what are the tax consequences as far as estate taxes, inheritance tax?
Right. Well, I don't go into too much tax stuff, just because I don't want I stay in my lane. Right. That's the key. I want people to understand that for me, my vision is to make sure that I'm a specialist in what I do. And I build myself around a group of people that do what they do. And so I have a tax consultant or professional that I work closely with. Okay. So when it's retirements and all that, I put the plans in place. People have the questions about the taxing side of it, put them right in connection with that person. That person works really, really well with them. But those are good questions, because a lot of people do have questions nowadays about taxing.
Okay, now, I just saw on the news today that the lottery winner, I think it was South Carolina, came and won like $1.3 billion, some astronomical number. Yeah. Mm-hmm. If that person called you and said, what should I do? What would be your first recommendation?
Well, I would obviously look at a lot of other factors, age, risk tolerance, and all of that type of stuff, what did they have available at that time. But generally speaking, I would be looking at a couple options. Diversification is clear. Okay. So I'll be looking at diversification. So am I putting all my eggs in one basket? Absolutely not.
Savings account.
Yeah. It's like, just put it in there, right? You get 1%, right? So that's not the place to do it, right? I will be looking at.
I got to protect my money,
and that's what they say. And you know what's so fun? I'm glad you brought that up, because a lot of people say just that. I need to protect my money. Well, savings accounts are about 1%, less than 1% actually. Inflation is about 3%. Your money is not keeping up with inflation if you put your money in a savings account. So you're not really protecting your money. You're really losing the purchasing power of your money if you choose to keep your money in a savings account. Okay, so I know people logically think that makes sense, but it really doesn't when you look at the numbers. So for that lump sum of money that we're talking about, a portion of it I think could be utilized for some form of an annuity, right? Where you can lock in and it's not as risky into the market. So that'll be a good place for some of that money. Obviously, there's so many cool products in the market nowadays where they have, things that you don't have to actually have high risk.
Right.
Some locked and fixed products. Then there's obviously some products that have been doing pretty well. Mutual funds that have been, which is just pretty much a diversification of stocks. And, they've been doing, they've been averaging 9 to 12%, over the years. I read another number in the last 50 years. Some of these investment products have averaged about 10.4%.
Right.
Pretty good,
Yeah.
And so we look at working to make sure that money doubles. We don't want the person to just have that money for their lifetime. We want it to transcend their lifetime to their children's life, to their children's children's life. That's what I call wealth, true wealth.
Now, you had mentioned that you were involved in behavioral management.
Yeah, years ago, yeah.
You received all this money. Mm-hmm. Psychologically, what should you be thinking?
That's a really good question, too, because I do take a psychological approach to finance. I believe that truly that's what it is. It's about our decisions, right, and our discipline and our habits. And so the psychological approach would be you need to act like you don't have this money.
Right.
I know it's hard, but you need to treat it like you don't have it because you didn't have it before. Right. And I'm a firm believer of if you didn't create the skills to create it, the money,
right,
you don't have the skills to keep it.
Right, exactly.
Okay, so I need to teach you how to develop the skills. Like, there's some people that have developed wealth. Well, they've created the skills.
Right.
But some people that just get lump sums, they've never created the skills. So I need to help you learn and understand the skills that it takes to keep that money. Right. And that's different. Yeah. Like I said, paying yourself first and making sure that don't even treat it like the money exists. I do have a couple clients that got lump sums of money for passing away of a family member and things of that nature. And, they gotten lump sums of money. And the first thing I said to them, you need to keep doing what you've been doing. Yeah. Keep working. Keep doing the things that you need to be doing. Obviously, can you do something small for yourself? Yes. But if you want this money to last, we need to put a game plan in place for that money.
Now, it's kind of tough to go back to work with $1 billion.
It's not easy. Doing that situation. So in that situation, it's like, do you really did you work because you loved it or because it was for a check, right? Because some people actually love what they do, right? And so that's fine. If you love what you do, continue to do what you love. But on the flip side of it, right? If you hated your job and you're like, thank you, I would have quit my job, then what are your passions? What are your passions? Why don't you open up a company? Why don't you, I believe money is a tool.
Exactly.
It's a tool. So don't just let it just grow. Create other opportunities for other people. Create other businesses. Like you were talking about taxes before. Taxes are really, to the business owners, the best benefit to the business owners, right? Employees don't get all the taxable deductions and things. Right. It's really more so for the business owner. So what is Uncle Sam trying to say? He wants other people to develop more businesses. So that I would think that they would want to really do what they're passionate about.
Right.
And maybe I could put them in contact with somebody that can help them develop that business model. So now, they have something working for them.
How about legacy? What's the best way that they can pass this on as a legacy to the next generation? Right.
So if you don't have a lot of money, and you need money, obviously, the number one way is life insurance, I think. Right. And I think that's very important. And I actually think that that's one of the number one problems in our community today. Everybody they're not clear on how life insurance works. Right. And so they don't want to purchase it. But we purchase car insurance. Right. We purchase iPhones, and cell phone, insurance, because we don't want to pay that astronomical price if we break it, right? But we don't pay life insurance, and that's something that we need to be more concerned about. So that is one way to create wealth in the event that, you pass away too soon. But if you have wealth already, like I said, you could create funds for your children, right. 529 plans. Those are a cool way for school and college tuition and things of that nature. Lord knows college fees are going up and up and up, and they will continue to go up, right? So we want to make sure that we can do that. Like I said, annuities are a good option, right? There's tons of investment products. It's just really a matter of us, and I do this. I do a financial needs analysis, which is a breakdown of who you are right now, where's your money allocated, and let's now put a game plan together to help you reach your goals and dreams.
Okay, now when we start talking life insurance, most people think life insurance, I need enough to bury me.
Yeah.
What's the basic, simplest approach to let someone know how much life insurance they need?
So I'm glad you asked that question. The first thing people need to understand is that life insurance is not just for burial.
Right.
Okay. Burial has been averaging about $10,000 to $12,000, which is pretty expensive. So you need it, but it's not just for that. I like to say it's for income protection. It protects the income that comes into your household on a monthly basis. Right. So I want you to think about it like this. If you had a household of 2 breadwinners and you had a $100,000 lifestyle, and each person was responsible for half of that, and one person disappeared, how long do you think that surviving spouse could maintain that $100,000 lifestyle now off of $50,000 of income?
Right.
Not long, right? Exactly. And that's what we're dealing with. We're not just dealing with the $10,000 for final expenses. We're dealing with how do we figure out a way to get that $50,000 back in the household on a yearly basis so they can continue to survive and their lifestyle doesn't plummet as a result.
Okay.
And that's what really life insurance is about. So the average practice is 8 to 10 times your income, right? You want to make sure that you have life insurance on you and or your spouse so they can so if one or the other, if something happens, or if not both, you have that money going to a beneficiary, whether it be a child if they're over the age of 18, I mean, you can have them as a beneficiary under 18, but there's estate issues and things of that nature. A company can't give a child $100,000 at 10 years old, right? So that would be an issue. So, but that's the most important thing, that income protection, making sure. And I really hit that home with people. I say, listen, and especially when I'm sitting with a husband and a wife, I look at the husband and the wife and I say, hey, listen, if his income disappeared, how long would you be able to maintain the same quality of life? Couple months. It's tops, most people say, right? And so then I look at the husband and say, hey, how comfortable are you knowing that you don't have anything in place for your wife right now? And now they start to really think about the magnitude of the problem. And so we put some things in place for them.
Now, I know there are different types of life insurance.
Yes.
Is there any preferred type, or is there suitable to the person's particular needs and their objectives?
Right. So I do think that there, I have a opinion. I think that there's a bunch of different products, and the focal point of each product is supposed to do something different, right? And so some people are adamant about what they believe in. So whatever they choose to believe in is fine. I personally believe is that people would prefer to have more money at retirement and less life insurance, right?
Okay, right.
So my strategy is always to make sure that you have more money at the end of retirement and not this big life insurance policy, right? So my goal is, and I'm sure you guys have heard Susie Ormans of the world, the David Ramseys of the world. They are pretty much in line with my approach, which is just an affordable term life insurance product that can cover your short-term goals and dreams if, God forbid, you were to pass away too soon. And then let's put together a mutual fund, an investment product that can grow your money. Because one key concept that people don't realize, and most times when I sit with people, they say, Terry, but what if I want a whole life product, or I want a cash value product because my money is growing in that fund. And I ask them questions that they don't know the answer to. I said, okay, if you were to take some of that money, does that affect your face amount of the policy? And they said, no, it shouldn't, but they don't realize it really does. That's a loan to that policy. So if you passed away while a loan is out, they got to get that loan back. The company's first thing say, I need my money back. So you just decrease the face amount. You just decrease the money that's going to your family right now.
Right.
And so it's really important for people to understand. I always sit with people and say, have you ever read your policy from front to back? What do you think most people tell me?
No.
Heck no. They never
Probably
done
don't even know where it is.
They don't even know where it is, right? And so I educate them on their own policy. I'm a firm believer of, and this is why I got good. I really wanted to understand where people were starting.
Okay.
You know, what do you have currently? Okay, and I can give you a recommendation. Hey, look, you look perfect. Keep doing what you're doing. You don't need me. Or I could say, we got some work to do, right? So that's one of the major concepts, you know, not just term by itself either. You know, some people say, are you a firm, adamant person of term? No, term without any investments
Right.
doesn't help you either. I mean, you need the product, but you need to also have the investment product as well.
Yeah. Pretty sound
Yeah.
advice. You know, term is great.
Yeah.
And I think people need to, first of all, be educated to make that decision.
Yeah.
I think a lot of times we come and we look at price relative to value.
Yeah.
There's always value relative to price.
Absolutely.
Also, retirement. We
Yeah.
talk about retirement.
Absolutely.
What do you recommend is the best way to retirement, or what vehicles are out there to help with retirement beyond the Roth IRA?
Got you. The first thing I always tell people is you must, if you have a 401k at your job, you must contribute.
Right.
You know, I can't give you free money.
Right.
Right?
Now, does it matter if you have a match or not, or should you?
I think that's the focal point. You should participate, especially if it's a match. Obviously, you can consider options if there is no match, right? So if there's a match, you must. And I really look at, you need to match up to the match point as close as possible. If you know, I understand if money is tight, then we'll look at that. But if you can match to the match point, match to the match point. If they're giving you 6%. And
it's free money.
It's free money.
Right.
Just take it. And just a side note, don't withdraw your money from there.
That's a big issue.
Oh my gosh. I see it all the time. And that's one of the things that people do that don't have financial coaches, financial advisors, things of that nature, because they don't know the severe implications. They just know that they need that money right now.
Right.
And they know that can save them financially right now. But they don't realize it's early withdrawal, penalties, taxes, right? It's all of these things. So that is, I always like to say, that's the most expensive money that you're ever going to take ever in your life if you do something like that. That can hurt you drastically. So 401ks are an important match. Traditional IRAs, you got SEP IRAs, simple IRAs, you got all types of different products, and it just varies based on if you're a business owner, if you're an employee, you know, what you can and cannot do. So those are some various things. I always say, like once again, I look at everybody's case by case scenario. I don't put, it's not a cookie cutter system.
Okay,
I don't put
so
everybody.
no exact formula.
Yeah, it's person to person. But I like that feeling because I want people to feel like they're an individual.
Right.
You know, they're somebody, and we want to look at your case by case scenario. Because let's be real, if you're an aggressive person, we will put an aggressive plan together for you. But if you're a moderate person, or I don't want to lose any money, like you said earlier. We got to look at other things for you.
Now, we all know we use the internet. Has the internet helped your business to educate people, or has it hurt your business because people think they can do it themselves?
That's a good question. I think it's helped overall because, with Facebook, Instagram, all of these social media, locations, I think it gets the information out there faster.
Okay.
I do think that some people think they could just Google things, and now they're a financial advisor, right? No, I don't think. I think that Google is good.
Advise the advisor.
Yeah,
right?
it's happened. I get calls like, no, I know what I'm doing. I just looked it up. Okay, like that doesn't work. You don't understand how the product actually works in relationship to other products.
Right.
And that's what I think people don't really get. They like understanding things, and I'm not telling you don't do research, but you can put something on Google. Anybody can put something on Google.
Right, an intelligent fool, right?
Right? Anybody can do that, and all of a sudden somebody thinks you're the expert, but you're not. So I would encourage people to work with people that are licensed professionals, because they've had to take tests, in order to have a clear understanding of the investment products that they're referring to.
Right, and they've spent the time and they have the knowledge.
Absolutely.
to understand what's going on.
Absolutely.
Well, Terrence, I thank you for coming in today.
Definitely.
This is Ron Williford, and Let's Talk Money.